The latest figures from Ireland's Central Statistics Office show a sudden jump in prices, grabbing national attention. In September 2025, the Harmonized Index of Consumer Prices, HICP, rose 2.7% year-on-year, a sharp increase from 1.9% in August. This leap marks the highest inflation rate in 20 months, signaling a potential end to the period of stable prices. For households, this means everyday goods and services are noticeably more expensive than a year ago. The rapid acceleration is a wake-up call for both policymakers and citizens, raising concerns about the future stability of the Irish economy. Interestingly, while annual inflation surged, consumer prices actually dipped 0.2% from August to September. This apparent contradiction is due to base effects. Last year's prices were unusually low, making this year's increase look steeper. Monthly fluctuations can be influenced by seasonal sales or temporary drops. But the broader trend is clear. Annual inflation is rising. The question now is whether this is a short-term spike or the start of a longer period of higher prices. Either way, Irish households are feeling the pinch, and the economic landscape is shifting. To understand the headlines, let's break down the HICP. The Harmonized Index of Consumer Prices is the EU's standard measure of inflation, tracking the cost of a typical household's basket of goods and services. This allows for direct comparison of inflation rates across EU countries, ensuring policymakers and the public are on the same page. When Ireland's HICP rises 2.7%, it means your money buys less. Unless your income keeps pace, you're effectively losing purchasing power. The HICP isn't just a statistic, it shapes decisions on social welfare, pensions, and public sector wages. It also guides the European Central Bank's monetary policy, influencing interest rates across the Eurozone. If inflation stays high, the ECB may raise rates, making borrowing more expensive for everyone. This impacts everything from mortgage payments to business investment. In short, the HICP is a critical indicator of your financial well-being and the health of the broader economy. Understanding it helps you grasp why rising prices matter. It's not just about numbers, it's about your everyday life. So what's driving this sudden surge in prices? First, base effects play a big role. Last year's prices were unusually low, so even moderate increases now look dramatic. But there's more. Energy costs have soared, pushing up electricity bills and fuel prices for everyone. Businesses facing higher energy and supply costs often pass these on to consumers. Global supply chain disruptions, like shipping delays and shortages, make imported goods pricier, and Ireland, as a trade-dependent nation, feels this acutely. Domestic demand is also strong. As people spend more, prices rise when supply can't keep up. It's classic supply and demand, but complicated by global factors. The combination of higher energy costs, supply chain issues, and robust consumer demand is creating a perfect storm for inflation. Policymakers now face the challenge of managing these pressures without stalling economic growth. The big question: are these factors temporary, or are we entering a new era of persistent inflation? Either way, the impact is being felt in wallets across Ireland. Understanding these causes is key to anticipating what comes next. How does inflation hit home? Start with the grocery bill. Staples like bread, milk, and vegetables are all more expensive. For families, these small increases add up, forcing tough choices and stretching budgets, especially for those on lower incomes. Energy bills are another pain point, with rising global prices translating into higher costs for heating and electricity. As winter approaches, some households may have to cut back on heating, risking discomfort or even health. Transport costs are up too. Fuel prices climb, and even public transport fares may rise as operators face higher expenses. Inflation also erodes savings. Money in low-interest accounts loses value each year, making it harder to reach long-term goals. This discourages saving and makes financial planning more challenging. The result? Even careful savers feel like they're running to stand still. Inflation isn't just a statistic, it's a daily reality, reshaping how people live and plan for the future. The squeeze is real, and it's being felt across every aspect of Irish life. Is Ireland's inflation unique? Not at all. Rising prices are a global trend, driven by energy costs, supply chain issues, and post-pandemic demand. Compared to other countries, Ireland's 2.7% rate is moderate. Some economies, like the US, are seeing even higher inflation. This shows Ireland is part of a broader global challenge, not an outlier. The European Central Bank sets policy for the whole Eurozone, so Ireland's fate is tied to trends in Germany, France, and beyond. Local factors, like housing, government spending, and wage growth, can amplify or dampen these global pressures. As a small, open economy, Ireland is especially sensitive to imported inflation. Understanding this mix of global and local forces is key to navigating what comes next. Rising inflation doesn't just squeeze households, it ripples through the entire economy. One risk is a wage price spiral. As costs rise, workers demand higher pay, which can push prices even higher. This cycle is hard to break and can lead to prolonged instability. Uncertainty about future prices makes businesses hesitant to invest, slowing growth and job creation. Government finances are also affected. Tax revenues may rise, but so do the costs of public services and social supports. Balancing these pressures is a major challenge for policymakers. Persistent inflation can hurt Ireland's competitiveness. If local prices and wages rise faster than those abroad, exports suffer. Imported goods may become more attractive, worsening the trade balance. For an export-driven economy like Ireland's, keeping inflation in check is crucial. The stakes are high, and the consequences go far beyond the weekly shop. The European Central Bank is on the front line in the fight against inflation. Its main weapon? Interest rates. With inflation above target, the ECB faces a tough choice: raise rates to cool prices, or risk stalling the fragile economic recovery. Higher rates make borrowing costlier, slowing spending and investment, but move too fast, and growth could grind to a halt. The challenge is even greater, because much of today's inflation is driven by global supply issues, not just local demand. Interest rate hikes can't fix supply chain problems or energy shocks. For Ireland, ECB decisions have immediate effects: higher mortgage rates, tighter household budgets, and more expensive business loans. The balancing act is delicate. Tighten too much, and the cure could be worse than the disease. Every move in Frankfurt is felt in Irish homes and businesses. The path ahead is uncertain, and the stakes are high. What's next for inflation? Much depends on global energy prices. If they stabilize, inflation could ease. If not, the pressure continues. Supply chain recovery is another key factor. Smoother logistics could help cool prices, but new disruptions could reignite inflation. Wage growth will be closely watched. If pay rises outpace productivity, a wage price spiral could take hold. Policymakers are focused on preventing this cycle from becoming entrenched. The most likely scenario? Continued inflation, possibly moderating, but not disappearing overnight. The ECB is expected to move cautiously, signaling possible rate hikes without acting too quickly. For households, the cost of living will remain a challenge for some time. Careful financial management will be essential. The road ahead will require vigilance from both policymakers and the public. In times of inflation, taking control of your finances is more important than ever. Start with a detailed budget. Track your income and spending to spot areas for savings. Review your savings. Money in low-interest accounts loses value, so consider options that outpace inflation, but always keep an emergency fund. If you have a variable rate mortgage, explore switching to a fixed rate to protect against rising interest costs. Shop around for better deals on insurance, utilities, and broadband to offset higher prices elsewhere. Invest in your own earning power. Seek promotions, negotiate pay raises, or build new skills to boost your income. Consider side gigs or freelance work for extra security. The best defense against inflation is growing your income faster than prices rise. With proactive steps, you can protect your financial future, even in challenging times. Inflation is tough, but smart planning makes a difference.